Hi, I'm Tom Stevenson, and welcome to Construction Business Management. In today's session, we are going to be looking at the gross margin and break-even point. This will assist you in being more effective in running your construction business. This whole course is based on construction business management, and we're right now in the section talking about financial statements. In the previous section, we looked at an income statement, and we'll talk about the income statement. It'll come up today a bit with gross margin and break-even point because it involves the income statement. So we're just taking our concepts a little bit further. And if you haven't seen the previous sessions, I'll put the links in the description below, and you can also subscribe, and you'll see under the playlist Construction Business Management a whole series in how to develop a business, a construction business, and some of the things that you need to consider in running a construction business successfully, and also how to develop a business plan. And this is a big part of this course that we're running here. So an income statement is taken at a period in time at the end of the year. So it's over a period of time is the best way to say it, at a period of time or over a period of time. It's not taken at a point in time. That'll be the balance sheet, which we'll be talking about coming up in the next sessions, where we take it at a very specific point in time. But an income statement, how much did you make over the past month? How much did you make over the past quarter? How much did you make over the past year? Very typical number that you look at. And what was your profit during that year? How much did your overhead cost? These are things that we would also look at over those periods of time. So definitely markup. Well, we looked at that, and that's the formula: total sales divided by job costs. And markup gives us the multiplier, the number that we would multiply our direct job costs with to arrive at a final price for the client. And markup, if we know that number, it's including what we've allocated for overhead and what we've allocated for profit. And if we apply that to our calculations, because as we said, people come from trades or different backgrounds, and they might know their specific area really well. Even if you were working as a site super or you were working as a project manager, you might not have been involved when you run a business in actually marking up the work. You have to understand that there's a lot of overhead costs, and we want to make sure that those are included when we give a price for a particular project. That if we were to add up all the projects we get in a year, that should, at the end of the year, allocate for our overhead, our office, our estimators, our cell phones, our trucks, and it should also include for our profit target, something that we're trying to achieve. Is it 5%? Is it 10% of sales? And if we do that, then if we achieve the sales that we were targeting, then by the end of the year, we should meet our sales target, our profit targets, and have covered and be able to pay our overhead. That's what that's all about. It comes further into the mix when we look at the break-even point. It's another measure that helps us to visualize that a little bit better. So that's really sort of that job cost times markup equals the sale price, as I was mentioning. And today, as I said, we're going to look at the gross margin percentage, which is pretty simple. The break-even point, which is a little bit more difficult to visualize perhaps, but it's a nice calculation that's very useful. And I find it's very useful if you set up a spreadsheet and you sort of every year you look at what was your markup for the year? What was your break-even point? How are you comparing year over year? Is your break-even point taking longer in the year to achieve? Is your markup becoming more or less? And it starts to identify trends. Ratios, as you'll see with the financial statements, are really good at giving you reference points that you can sort of look at and you can see, is there a trend forming here? And if there is a trend, is it a good trend or not so good trend for us? Not so much that, just a target to try to achieve, but more trends that are going on and determining, is this good or is this bad? Are we doing it with for a purposeful reason to achieve a certain end result? And does this make sense for us? No one number tends to tell the whole story, shall we say. So income ratios and formulas, as I was mentioning, as I said, no one ratio will tell you the whole story, but it does flag any potential problems. So I really want to emphasize that as we go forward in this and the next few videos. Ratios are very helpful, but you shouldn't let one negative ratio sort of cause panic or that sort of thing. You could even have, looking at your profitability from year to year, look that maybe in 1 year, the last year, it went negative. Maybe that's partly due to you expanding during the year, and so you incurred some extra costs, and maybe that expansion, it's taking a little bit longer than you thought, or even maybe you if you really look at your numbers, it shouldn't be a surprise to you that your profit went down from the previous year because you expanded your office, you hired an extra staff member, but now your sales is on the uptake. And so if you continue your sales on that trend, maybe the next year you can extrapolate that and say, yes, our profit went from 100,000 to 60,000 from 2 years ago to last year. But we're going to be on an upward trajectory because we're going to be putting these new investments and increase in overhead to work, that now our sales is increasing, and we're looking at this trend, and we can see that in the next year we're going to make $200,000 worth of profit. So it might be a little bit of a hiccup in the road on the way to future prosperity. But on the other hand, if that wasn't the plan and sales aren't increasing, then you've got to start really digging into it and look at some of the other measures. So gross margin percentage is a relatively straightforward aspect. And if you remember, we talked about gross income, right? So really, when we think about gross margin percentage, it's looking at gross income as a percentage of overall sales. So really what that means is we just have to figure out what is our gross income. We've got to know what our overhead and profit is. And if we have an income statement, we'll have that. And our cost of sales, and which would add up to our total sales. And if we take this number and we divide it by this number, it will give us our gross margin percentage. So if we take an example, a job has a sale price of $150,000 and has costs of $85,000 directly attributed to it. So has costs directly attributed to it. So that would be the $85,000 cost of sales. Then its gross income would be $150,000. For that particular, we're just looking at this point on an individual project. We can look at this then on our overall sales for the year as well. 150,000 minus 85,000, that gives us 65,000. So if we take the 65,000 and divide it by 150, that gives us a gross margin percentage of 43%. We could also just as easily have said, we had sales of $2 million. Our cost of sales was $1.5 million. That would mean our gross income is $500,000. So $500,000 divided by the $2 million, that would give you your gross margin percentage. And if that'd be looking at it perhaps for a year, your year of sales and cost of sales and overhead and profit. So it kind of gives you a picture of what percentage of all of our sales is going towards overhead and profit. What percentage? This tells us a dollar amount. This tells us a percentage. Fairly straightforward, and it's just using numbers from your income statement. The nice thing too about a lot of this is if you have a spreadsheet with your income statement set up, you could have, if you're doing projections like for a business plan, As we said in one of the earlier videos, you could have 2022, 23, 24, 25. You could have it projected out 5 years with what just happened if that was the case. If we're finished 2022, looking forward for the next 5 years forward, you could have all these projections that you're surmising with the growth of the business that you're going to try to drive towards achieving maybe a certain sales level. Maybe it's that you want to, in 2027, have a sales of $2 million. Well, we're here in 2022, we just finished. Then what are the things we're going to have to need to do to get there? And you're projecting that, and you're looking at that, and what kind of growth it's going to require, and what that impact that might have on your overhead, etc., as you expand. So below that, you could have a number of cells that would have a series of formulas in them that would do a lot of these calculations, like this calculation. And then you can start to see a trend is, oh, if we get that new office, look what it does to our overhead. Look what it does to our gross margin as a percentage. Does this make sense for us? And you can look at the past, and you can look at the future, and you can make determinations from that. It's just giving you some information that you normally wouldn't have. There's a lot of variables that we have to look at when we're deciding to do things. And this is being proactive instead of reactive. Most people, when they start a small business, they really don't think too much about anything, and they just go day to day. And that's why you have such a high failure rate in businesses. They really don't know the consequences of their actions, so then they don't learn from their actions. That'd be one thing. And two, they take actions that if they knew more about, they would not have done, because it potentially could have put them at risk financially. That would be another one. So you can see how that can make a big difference in giving you and providing you with that information. And so that visual representation of the income statement is very helpful for that perspective. I keep bringing this up in the various videos, and it's really because I think you should just get this really built into your mind. Total sales, cost of sales, overhead, profit, how they add up, how they work together, and how they interact. And it really, just having that sort of burned into your mind, it really helps you just see things in a different light when you're taking certain actions, and you have a better understanding of how the world of work comes together. So, gross margin percentage, it is that number that we mentioned. It is that formula that you can sort of visually see. And again, once you have that income statement in mind, how it's formed, you can very easily see how it comes about. You can even, it's not even really something that you really have to memorize. You just look at the chart and it just visually makes sense. Okay, so this over that number is going to give me a percentage of what this is of the overall project amount. And this is where it can actually vary quite widely by some companies. Some companies are running rather fat, as we would say. They've got a lot of excess in overhead, a lot of waste in overhead. You know what? We could say the same thing about some people and how they run their lives, right? You have the stuff that you need for your day-to-day functioning to eat and things of that nature. And then you've got, things like your room and board. You could be spending a lot more. For some people have $4 million houses when they really should only have, they can really only afford a $1 million house or what have you. And that really can be problematic depending on what their total income is and what their overhead and aspects are and what their savings are. There's a lot of different ways of looking at financial statements, not just from a business perspective, but from a personal perspective. And then it starts to make a little bit more sense to you. You'll see when we talk about the balance sheet, it really starts to make sense when we start looking at the different elements of a balance sheet. So if we have a company that has $3 million in total sales for the year and has job costs of $2,400,000, what is their gross income and what is their gross margin percentage, right? So now you know what their sales are, you know what their job costs are, what is their gross income, and what is their gross margin percentage. So maybe just pause this right now and make sure that you can calculate that first off without even really sort of going back to that chart. You can see the formula up here, but I would even try to do it without looking at the formula and just look what each thing is and see if you can work it out to gross margin percentage, because you should pretty much be able to do that just looking at it now that you know the components. So just taking it out, if you've done all of that, you could go with the formula, and then this would give you 0.2 or 20% gross margin percentage. So that is 20% of your sales. That is what you have in that particular problem going on, where you have those numbers in place. The other thing I find with gross margin percentage is people get it mixed up with markup. They think it's the same thing. And it's not. It's the percentage of the overall sales. Whereas markup is, what do I need to, it's the multiplier I need to multiply my job costs by. And so if we were to take that same example, right, that we just did, and you calculated out 20%, and we wanted to figure out what's the markup, well, it's a different formula. It's total sales divided by job costs, and that's going to give us 1.25. So we would be multiplying that direct costs by 1.25, or you're multiplying it, and you're taking the direct costs and you're adding 25% of the direct costs on top of the direct cost. That's why it's easier just to use the 1.25 as the multiplier. So it's good for you to sort of work that out. So that would be markup of 25% compared to 20%. So they are not the same thing. Markup and gross margin percentage, not the same thing. Break-even point. Okay, so this is the one that's a little bit tricky to sort of visualize. It's when the gross income equals the total overhead expenses. In other words, no profit is involved at the break-even point. It's the point, and we usually do it by the year if we're going to do it by calendar. It's the point where in the year, if you started in January, where how long you have to work before you've basically covered your overhead and now you're into profit, right? So it's a certain point in the year where you've worked that period of time and now you're into the profit section. They used to always, I don't hear it so much lately, but they used to always announce usually it was sometime in June. I think the last time I heard it was early July. At what point in the year, right? At what point in the year are you free of paying taxes? What does that mean? They were saying that if you take all of the taxes that you pay, you buy something, you pay your sales tax, you pay income tax, right? So when you get your pay, it's of course smaller than what your pay is because you pay a substantial amount in income taxes. You have a home, you pay property taxes on that home. Well, if you add up all the taxes that you pay and all the money that you make, and you put it into a formula, at what point in the year are you starting to make money for yourself? That's the logic. And so really it shows a trend, and it really is it grabs people, because you mean I have to work till the end of June just to pay all the taxes that I'm going to end up paying in the year for what I earned? And then especially this year, now it's into July, taxes are increasing as an overall percentage of what I've been making, and it's taking longer. Then that's very upsetting, right? Like people will chew on that for a while. So it's a different perspective as opposed to just saying you're going to pay 52% tax overall if we take all the taxes, or we're going to pay 38%, or you're going to pay 25%. I don't think it's going to be 25%, even when you look at all the different taxes, unless you're really, really low income. So that can have that impact. So there is this formula, break even equals total overhead divided by, and I kind of got these brackets around it, total sales minus job costs divided by total sales. So that's kind of giving you that form. This is giving you the how to calculate the break-even point in dollars, but I'm going to show you how then you got to take it a step further to actually break it down into finding out where in the year it is. So if we take an example here where we have some numbers, total sales 300,000, total overhead 75, total job costs 200,000, break even. So we plug all the numbers in. The break even point is 225,000 for the year in dollars, right? So that's in dollars. So to convert to the month and day of the year, you divide the yearly sales income by 12. That just gives you the number. It gives you a perspective of how much money you are making per month. If we spread it out evenly, it's probably not going to be evenly, but we just do this for this formula. And so that's 25,000 potential monthly sales volume. As I said, it doesn't have to be, it doesn't matter that it's up and down for this. It just gives you a good perspective. Divide the break-even point by monthly sales volume. So we take our break-even point here, which was our 225,000. We divide it by 25,000, our monthly sales volume, and it says 9. That would mean 9 months. That would mean 9 months is completed, right? If it said 1 month, it means you've done that whole month. If it says 1.1, you've done all of January and 10% of February. That's how that works. So people get that wrong and they'll think it's the beginning of September. It's actually the end of September. If it was 9.2, it would, or 9.5 maybe better. 9.5 would be going into the middle of October as an example. So a graphical view of the break-even point, what is it saying? I don't understand. Well, what it's saying is typically your overhead is going to be, and these things you have to kind of visualize, and they're not like hard stone. Like I'll try to sort of give you a little bit of variance in this, but our overhead, if we've sort of gone ahead with our income statement and we go back to that income, actually I don't think I had it up here. Maybe not. No, I don't think so. But if we go back to our income statement here, we've got our total sales, we've got our cost of sales. We've done some projections on what our overhead is. Like what's our monthly rent? What's the cost of our estimator? What's our truck payments? What's the gas that's typically used? And if you've already done a year, you've got a good baseline to measure against. You can allow for inflation. You could allow for new things that you've got an idea about. But you pretty much flatlined that overhead in your calculation. So we've got that overhead amount that we're utilizing in the break-even calculation. All right. And we're looking at, well, it takes a while to actually pay out the overhead, right? We've got certain amount of sales. So if this is our sales, and let's say, this is 0, this could be $1 million, and this could be 800,000. So this is increasing sales volume. And of course, the more sales you do, the more costs you have involved, right? So the more sales you do, you're going to be able to collect that revenue, but you're also going to have more costs involved. So over here, obviously, the job costs, because you would have sold more renovations or additions or construction projects, is higher. But of course, your job costs are higher because you've done more. Your overhead, however, has flatlined here because you're paying for your office, you're paying for your estimator, you've just been better utilizing, optimizing your overhead. So at a certain point, you're not optimizing your overhead, and partway through the year, you have not paid enough to pay the overhead, because the overhead is happening whether you have projects or not. All right, the overhead, like if you have an office and you're renting it, it's happening whether you have this project or you don't have this project. So it's not necessarily directly related to the projects. Now, this is where it gets a little bit, not 100% true. If we found at a certain point we just weren't making the sales, well, perhaps we lay off the estimator, perhaps we shut down the office and we work from home or whatever. So that can vary. But with this model, we're taking the idea that our overhead is going across at this amount, our sales is projected to be this amount, our job costs are projected to be this amount. So at what point do we break even? Because after that break even point, then we start to make a profit. And if we can actually do more sales than we predicted or thought, then you know what? Our profit is going to be a bigger overall amount. If we do less sales, then our profit would be smaller because we would still be paying a certain amount of overhead. And if we don't make the break-even point with our sales, then we're going to be losing money. All right, then we're going to be losing money. So the break-even point gives you that indication of when in the year have you paid for your overhead and, of course, your sales up to that point. Then from that point forward, you still are going to be paying for your job costs, that new job costs that come. But the other portion, remember, that we marked up is now going to be going solely towards the profit. So you're still going to be incurring the job costs and the profit going forward, but you've already paid for your overhead for the year up to that point. So the break-even point gives you that sort of point. And as I said, it's a really good reference point because you know where in the year it is. Not so much because it's in the year, but then next year, is it ahead or is it behind? If we're September 20th, that's fine. Next year, we're September 30th. The year after that, we're October 15th. The year after that, we're November 10th. That's starting to show a very serious trend that it's taking you later and later in the year to be able to reach the break-even point. At some point, that might mean you're losing, right? Because you can't make the break-even point during the year, which means you're in loss the whole year. So it's helpful to give you a feedback mechanism to see a trend and to be able to think about it. And then you're going to dive deeper to try to say, well, why is this happening? What do we need to do? It helps you with your overall business strategy to adjust. No plan stays exactly the way you want. And when something starts to deviate, you want to see, what do we need to do to course correct? Or do we have to change our plan? And we've talked about this in one of the earlier lectures when we talked about having a mission, having a vision, developing a strategy, and then there's tactics, and then there's adjustments. So tactics are the small tweaks that we've got to do to keep ourselves in alignment. And maybe at some point the strategy isn't making sense, so we've got to revise or redevelop it, drop whatever we currently have, change things because other factors in the external marketplace have caused this. So these are some of the things that come into play with this when we look at the break-even point. So maybe we try to calculate this one here. So we've got total sales, total overhead, total job costs. Why don't you see if you can calculate using this the break-even point? And take a few minutes and try it. And you know what? If you're having a problem or it's an issue for you, just put a note in the comment where you're having trouble visualizing things. It might give me some feedback that I might be able to answer if you put it in the actual comments below. That's probably where I would see it the quickest. So yeah, you have total sales, you have total overhead, you have total job costs. So you can figure out the break-even point in dollars. And then remember, we want to get our monthly sales amount, right? So we want to basically take our sales and divide it by 12. And then we want to use that amount to divide into our break-even point in dollars. And that's going to tell us whatever the number of months is and a decimal point. So see if you can do that. I'll take a minute and you can actually just pause this and I'll continue on. All right, so I'll give you a second here so you can pause it. Good. All right, so we're back and we're just going to run through and see how you did. Break-even point in dollars from the previous slide, if we did those calculations, is 330,000. As I said, we divide that number by 12. We get 37,500. We're going to take this and divide it by that. All right, and that's going to give us 8.8. Now what you got to know, if you looked at that, before I go further, what month is that? What month is that? And is it the beginning of the month or the end of the month? And then the 0.8, what do we have to do with that? 8 means 8 months is finished. August is the 8th month, so we're done August. We've done August. 0.8 is 0.8 of the next month. That would be September. And you could take 0.8, you can get really crazy with this, but you could take that, how many days is in there in September? 30 days has September, April, June, and November, so 30 days. And you could take 0.8 times 30, and that would give you how many days? All right, 0.8 times 30, that should be 24. So it should be working out to September 24th, unless I did the math wrong in my head. And yes, it is. Okay, so it's September 24th. Like a day here, a day, like we're just roughing this out to get a perspective, and we're kind of doing the same thing, the same process, so that we can compare year to year in our projection statements and in our actual statements. As you progress in the years, you can look back and you can see how is it deviating. It's good to look at trends, but I will say, it'll come up in another slide in another lecture. There is something called Stein's law. I love Stein's law because it's so simple. Stein's law, and you can look it up, Google it. Stein's law is a trend will continue until it stops. A trend will continue until it stops. Well, the whole idea is you see the trend and then you can take action to say, you know what? It's starting to trend that we're getting later in the year. So it looks like we're getting tighter and tighter. We're increasing our overhead and we're not increasing our sales proportionately. What are we going to do about it? How are we going to stop it? How are we going to redirect, all right, the ship so it's going in the right direction? So Stein's law, a trend will continue until it stops. The whole point is we gather information so we can do something about it. Doesn't mean it has to happen that way. So keep that in mind. So that's what I actually wanted to cover in this previous video. In the next video, we will be looking at financial statements and the balance sheet. And as I said, I will put some links in the notes below here. I'll put some links to the previous videos. Please click subscribe and click the little bell so you're notified of updates as I upload them. I have a lot of information on my YouTube channel to deal with construction and project management and MS Project and other areas. So I hope you enjoyed this video, and I'm Tom Stevenson wishing you a wonderful day, and we will see you next time. Bye for now.